Your neighbor Bob is 70, retired, pays $290 in federal taxes on $100,000 of income. You are 50, still working, earn the same $100,000, and hand the IRS $15,393. Same country, same income. You pay 53 times more. That's the headline. But here's what the headline doesn't tell you. In a good year, with the right structure, Bob's federal tax bill doesn't drop to $290. It drops to zero. Not a rounding error, not some exotic strategy. Mathematically zero, by design, using rules the IRS publishes in plain sight for anyone willing to read them. And if you're in your 40s or early 50s right now, the decisions you make in the next 5 to 7 years determine which version of that math you end up living inside. This video is not about tax avoidance. It's not about offshore accounts, trusts, or anything that requires a lawyer charging $400 an hour to explain. It's about understanding that the tax code treats employment income and retirement income as two structurally different things, and that most people spend 30 years building wealth using the wrong map because they assume those two things work the same way. They don't. The gap between them is wide enough that it changes your actual retirement number, sometimes by hundreds of thousands of dollars, because you've been calculating how much to save using a tax rate that won't exist when you get there. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They apply a working person's tax rate to a retirement income projection, and they systematically overstate how much you need to save. Mine uses BlackRock and Vanguard modeling logic to expose the weak points in your actual plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Now, I want to give you a metaphor to hold on to through this entire video, because it's going to come back at every step. Picture your income as a car driving from where it's generated to where it lands in your bank account. While you're working, that car drives down a toll road with multiple booths. There's the FICA booth, Social Security tax, and Medicare tax. 7.65% gone before you make a single decision about the money. There's the federal income tax booth. There's the state income tax booth in most states. There are the work-related expenses, the commuting costs, the professional wardrobe, the lunches, the costs of being employed. By the time the car reaches your bank account, it's much lighter than when it left. Now picture a different road running parallel to that toll road. Same destination, same starting point, same amount of money generated at the source. But this road has most of the booths closed or removed entirely. A few are staffed lightly. Some are completely unmanned. That's the retirement road. And the entire game between now and the day you stop working is about building enough cars to send down the second road before you get there. The tragedy of conventional financial advice is that it tells you how many cars to build. It almost never tells you which road to put them on. Let me tell you about a guy named Ray. Ray spent 32 years as a high school principal. Good salary, disciplined saver, maxed his retirement contributions almost every year. By the time he was 67, he had built $2.1 million in savings. He felt secure. His financial advisor ran the first-year retirement income projection, and the math looked fine on paper. Then the first quarterly tax estimate arrived. Ray stared at it the way you stare at a restaurant check, that's somehow $50 higher than you expected. He'd done everything right. He followed every piece of conventional guidance, and somehow retirement felt more expensive than working had. What nobody had told Ray across 32 years of disciplined saving was that having $2.1 million in one type of account means every single dollar you ever spend for the rest of your life gets processed through the same toll booth. There's no second road. He built all his wealth and forgot to build the alternate route. We're going to come back to Ray later in this video because his story doesn't end where you think it does. So let's start at the foundation. Why does Bob's tax bill look so different from yours on the same gross income? The answer isn't one thing. It's three things stacking on top of each other in a way that most people never fully map out. And I want to go through them in the right order because each one changes the context for the next. The first mechanism is the most mechanical, FICA. When you get a paycheck right now, before federal income tax is even calculated, 7.65% comes off the top. Social Security tax at 6.2% Medicare tax at 1.45% on a $100,000 salary. That's $7,650 removed before the IRS calculates anything else. Your employer also matches that amount, which is technically not your money, but it represents a tax on your employment that comes directly out of what your labor is worth. The moment you retire and stop receiving W-2 wages, FICA disappears. Not deferred, not reduced. Gone. Bob doesn't pay Social Security tax on his investment withdrawals. He doesn't pay Medicare tax on his pension income. That $7,650 that used to evaporate from your paycheck before you could make a single choice about it stays in his pocket. The people who dismiss this as a small thing are doing bad math. $7,650 a year, invested at a 7% average annual return over a 20-year retirement, compounds to over $300,000. The first toll booth closing isn't a rounding error. It's a car that gets to start its journey intact. The second layer is the standard deduction. In 2026, for a married couple filing jointly, the base standard deduction is approximately $30,000. But once you and your spouse both turn 65, the IRS adds a bonus deduction on top of the base for each of you, bringing the total to somewhere in the range of $32,000 to $33,000, depending on how inflation adjustments land. On its own, that's not dramatic. But here's how it functions inside a retirement income structure. Bob's Social Security income doesn't fully count as taxable income to begin with. Up to 85% of Social Security benefits are included in taxable income if your combined income crosses certain thresholds. And below those thresholds, the percentage drops to 50 or even 0. If Bob's income mix is structured carefully, the expanded standard deduction can shelter almost all of his taxable income before the IRS begins calculating what he owes. That's the second booth going unstaffed. The third layer is where the math becomes genuinely surprising. And this is the actual mechanism behind Bob's $290 federal tax bill. If your taxable income as a married couple filing jointly falls below roughly $94,500, your federal tax rate on long-term capital gains is exactly 0%. Not reduced, not deferred, 0. This means Bob can sell appreciated investments, the index funds and ETFs he's held since his 50s, and the federal government collects nothing on those gains. He's already used his deductions to shelter his Social Security and his modest traditional IRA draw. The remaining income comes from assets held longer than a year, moving through the 0% capital gains lane. The toll booth exists on the map. It's just closed for him. That is not a gray area. That is not aggressive planning. The IRS publishes that 0% rate in its standard annual tax tables. It was built into the code because Congress treats capital gains as a different category of income, one that went through corporate level taxation or originated from after-tax savings. The 0% bracket is there by design for people who structured their income around investment returns rather than wages. Most financial media doesn't lead with this because there's no product to sell you once you understand it. It's a rate. You either qualify for it or you don't. And whether you qualify depends on decisions you make today. Now connect all three layers. FICA evaporating off the top, the standard deduction expanding, the capital gains rate dropping to 0 if the income mix is right. Bob's $100,000 is coming down a road with most booths closed. Yours is coming down the road with every booth fully staffed. Same gross number at the source, completely different amount reaching the bank account. And the part that changes your retirement planning entirely is this. If Bob needs $100,000 a year to live the same lifestyle as you do today, he needs to generate significantly less gross income to get it because the roads he built carry the money more efficiently, which means your retirement number, the actual savings balance you need to fund your retirement, might be lower than what you've calculated. Not because retirement is cheaper, but because your net income in retirement can be a much higher percentage of your gross than it is today. Most retirement projections assume something close to your current effective tax rate, which is built around employment income. Apply a retired person's tax structure to the same gross withdrawal, and the effective rate can drop from around 20% to somewhere between 2 and 5%. That changes the math, sometimes significantly. In a few minutes, I'm going to show you exactly how one specific account decision made before age 55 determines whether you're in Ray's position at 67 or somewhere much better. But first, here's why the conventional advice on this is even more broken than you might think. The financial industry broadly doesn't have a strong incentive to point out that your retirement number might be lower than you believe. An anxious saver contributes more. A higher balance generates more fee revenue. A 2% annual management fee on $2 million is $40,000 a year in fees paid to someone else. A 2% fee on $1.4 million is $28,000. The industry has a structural preference for you to feel behind. That's not a conspiracy. It's just how incentive alignment works in a fee-based business model. I say this as someone who has spent over a decade surrounded by accountants, fiscal lawyers, and investment managers who are all individually good people and collectively part of a system that profits from your uncertainty. Understanding the tax structure doesn't make you cynical. It makes you harder to sell something to when you don't need it. Now, here's where most people make a logical error. They hear everything I've described and they think the solution is simple. Max out the 401k, let it grow, arrive at retirement, and collect the tax benefits. The 401k is the vehicle. The tax advantages are the destination. That logic is reasonable. It also misses the most important structural problem in retirement planning, and it's the one that turns a disciplined saver into someone who's frustrated at 68. The problem isn't how much you save. The problem is which bucket you put it in. Let me introduce you to Sarah. Sarah is 61. She retired last year with $1.8 million in savings. That's a real number. Most people her age would look at that balance and feel relief. Here's the problem. Every single dollar of it is sitting in a traditional 401k. When Sarah needs money, a new roof, a car, a medical expense, a generous gift to her daughter, she has no choice. She opens the 401k, makes a withdrawal, and every dollar gets treated by the IRS as ordinary income. Same tax category as a W-2 paycheck. Same brackets. It doesn't matter that she spent 30 years building that balance. The moment she touches it, the meter starts running, and she's back on the toll road she thought she'd left. Last year, she needed $78,000. Between the withdrawal and her Social Security, her modified adjusted gross income crossed a threshold she didn't know existed. Her federal tax bill was higher than expected. That she could absorb. What she wasn't prepared for was the Medicare statement that arrived a few months later. Her Part B premium had gone up substantially. This is Irma, income-related monthly adjustment amount. It's a Medicare surcharge that activates when your modified adjusted gross income crosses specific thresholds. In 2024, a single filer who crossed $85,000 in MAGI could see their monthly Part B premium jump from around $175 to over $244. The next threshold pushes it higher still. And the detail that makes this particularly painful is that Irma is calculated based on your tax return from 2 years prior. The decision Sarah made in the emergency moment of a bad roof year showed up as a higher Medicare bill 2 years later when she'd long forgotten the connection. She did everything right by the standard playbook. She followed the advice, hit a real number, and arrived at retirement with no flexibility because all her wealth was on one road, and that road still had booths. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Irma is especially brutal because it operates on a cliff structure, not a gradual slope. You can have $99,000 in MAGI and owe one amount to earn $103,000, and you jump to a materially higher premium. The difference between those 2 points can be thousands of dollars annually, triggered by a single withdrawal decision, a car repair, a home emergency, a one-time expense that felt unavoidable. If all your money lives in pre-tax accounts, you cannot route around that cliff. You go over it and you calculate the damage afterward. And then there's the single filer penalty, which almost nobody models in advance. A friend of mine, someone whose financial situation I know well, lost her husband about 2 years ago. She hadn't changed her spending, hadn't changed her investments, but her filing status went from married filing jointly to single, and her entire tax picture shifted. The income thresholds for capital gains, for Irma, for how much Social Security counts as taxable, all of those cut roughly in half. In 2024, the 0% long-term capital gains threshold for a married couple was approximately $94,500. For a single filer, it was roughly $47,250. Same investment income, same behavior. Single filer pays 15% capital gains. Married couple pays 0. The code doesn't adjust for circumstance. Widowed, divorced, never married. The brackets don't care. For retirees who lose a spouse, this shift can cost $10,000 to $15,000 per year in additional taxes. Not temporarily. Every subsequent year, because the thresholds don't follow you into your new situation. Serious retirement planning needs to model both scenarios. Most plans don't. This is where it gets really interesting, because here's the reversal that changes how you should think about all of this. You probably believe the problem is that you haven't saved enough. That's the story the financial industry tells, because it leads naturally to a solution they can provide. Save more, contribute more, buy more of the products we offer. But for a lot of people in their 40s and 50s who have been reasonably disciplined, the problem isn't the size of the balance. The problem is which bucket the balance is in. You may already have enough, or be closer to enough than you think, but you're holding it in the wrong container, which means a significant portion of it still belongs to the government, and you don't yet know what the bill will look like. There is a version of retirement, a common one, where you have done everything right by conventional advice, followed every standard recommendation, hit a number that looked great on paper, and you still end up with less flexibility than you expected because every withdrawal triggers a tax event you cannot avoid. You think the problem is the balance, but actually the problem is the bucket. Now here's something even more specific that most people don't plan for until it's already happening. At age 73, the IRS begins requiring you to make withdrawals from your traditional pre-tax accounts, whether you need the money or not. Required minimum distributions, or RMDs. The amount is calculated using a formula based on your balance and a life expectancy table the IRS updates periodically. You don't negotiate it, you don't opt out. And every dollar of it lands as ordinary income on your tax return. A traditional 401k balance of $2 million at age 73 produces a required minimum distribution of approximately $73,000 in year one. Add Social Security, add any pension. You can easily push into the 22 or even 24% federal bracket. Irma gets triggered. The portion of Social Security included in taxable income rises, and if you have surviving spouse concerns, you're now looking at running all of those numbers through single filer brackets. The government built a withdrawal schedule for your money. If you only have one road, you're on that schedule, whether the timing suits you or not. The specific year that gets people most often is their first RMD year, 73, when they're simultaneously drawing Social Security and pulling the mandatory minimum from a large pre-tax account for the first time. I've seen this situation described by financial planners as the RMD collision, multiple income sources converging in one tax year in a way that pushes someone into a bracket they weren't expecting and triggers surcharges they didn't anticipate. The collision is entirely predictable in retrospect. But by the time you're 73, the restructuring window is effectively closed. Let me show you what the difference actually looks like in real numbers, because abstractions only carry you so far. Take Marcus. He's 47, married, earns $120,000 a year as a project manager. His wife earns $80,000. Combined household income, $200,000. They've been diligently maxing out traditional 401ks for 14 years. Current combined balance, approximately $850,000. They feel reasonably good about this. They should. That's a real number built through real discipline. Here's the picture at 65 if the savings strategy doesn't change. That $850,000 grows to roughly $2.2 million by retirement, assuming a 7% average annual return over 18 years. Every dollar of that $2.2 million is pre-tax. Every dollar they spend in retirement is ordinary income. If they need $100,000 a year to live, $100,000 goes on their tax return as ordinary income. Medicare premiums are calculated based on their MAGI from 2 years prior. Social Security gets partially included in taxable income because their income is high enough to trigger it. Their effective tax rate on retirement income ends up looking surprisingly similar to today. The toll road still has most booths staffed because everything is flowing through the same channel. Now picture Marcus making one structural change this year. He redirects contributions above the employer match into the Roth 401k option his company already offers. And he opens a taxable brokerage account for surplus cash flow, filling it with a broad market index fund and leaving it alone. 18 years later, at 65, his total balance is similar in size, but it's distributed, pre-tax in the traditional accounts, tax-free in the Roth, and taxable brokerage sitting on accumulated long-term gains. When they need $100,000 in retirement, they draw from multiple sources. Roth withdrawal, tax-free, no MAGI impact. Long-term gains from the brokerage at the 0% rate if their ordinary income stays below the threshold. A modest traditional account draw carefully sized to avoid Irma. Their effective federal tax rate on $100,000 of retirement spending? Low single digits. The toll road is mostly empty. Same career, same income, same total savings rate. Different roads. The gap between those two outcomes isn't investment skill. It isn't luck. It's where each dollar was directed between 45 and 55. Now, for people who are already heavily weighted in pre-tax accounts, there is a specific repair strategy worth knowing about. It's called a Roth conversion ladder. The core idea is this. In the years between when you stop working and when Social Security begins, your taxable income often drops significantly. That's a window. During those low-income years, you can convert a portion of your traditional IRA or 401k into a Roth IRA, paying income tax on the converted amount at whatever bracket you happen to be in at that moment. If timed correctly, you might be converting at a 12 or even 10% marginal rate. The converted money then grows tax-free. Withdrawals later are tax-free. And because you've reduced the size of your pre-tax accounts, your future required minimum distributions at 73 are smaller, which means less forced ordinary income, less IRMAA exposure, less Social Security dragged into taxable territory. This is the kind of restructuring that happens in the gap between the last W-2 paycheck and the first Social Security deposit. That gap is usually 3 to 5 years for people who plan it deliberately. Those years are arguably the highest leverage window in all of retirement planning, and most people don't know they're sitting in it until it's half over. Here's a small but important detail about the mechanics. Roth IRA withdrawals don't count toward your modified adjusted gross income the way traditional IRA withdrawals do. That's not a minor nuance. It's the reason Roth accounts are invisible to the Irma formula and to the Social Security taxation threshold and to the capital gains rate calculation. When you draw from a Roth, the IRS doesn't see it as income in the same way. It doesn't trigger the cascades. It's income that already went through the toll booth on the way in, so the booths on the way out are closed. This is why the Roth road is not interchangeable with the traditional road from a retirement income perspective. Lower tax rates today feel like the argument for traditional contributions. But the flexibility and the MAGI invisibility of the Roth road in retirement is worth something that a current year tax deduction doesn't capture. The value of having income that doesn't trigger surcharges, doesn't push your capital gains rate higher, doesn't add to the percentage of Social Security included in taxable income, that value compounds over a 20-year retirement in a way that's genuinely hard to model, but very easy to feel. Now let me come back to Ray. Ray, the principal with $2.1 million in his traditional 401k and no other roads, was 67 when he retired. He had 2 years before Social Security would kick in. His advisor at the time, a genuinely good one, recognized the opportunity sitting inside that gap. For 24 months, Ray lived modestly off cash savings he'd accumulated in a regular checking account. And he converted approximately $180,000 per year from his traditional IRA into a Roth, paying income tax at a relatively low effective rate because during those 2 years, his only income was the conversion amount itself. He kept the converted amount size to stay within the 22% bracket, not glamorous, but far better than the rate he'd have paid during peak earning years or the rate future RMDs would have cost him. He also sold appreciated holdings from a small taxable brokerage account he'd opened back in the 90s, mostly forgotten. Because his income during those conversion years was structured carefully, his capital gains qualified for the 0% rate. He essentially harvested gains for free during a window he didn't know he had. By the time Social Security started at 69, Ray's pre-tax balance had dropped from $2.1 million to approximately $1.4 million. His Roth balance had grown from near zero to $360,000. His future RMDs would be meaningfully smaller. His MAGI in later years would be more manageable. He hadn't fixed the whole problem. You can't fully fix 30 years of single bucket savings in 2 years. But he bent the curve. He bought himself optionality he didn't have the week he retired, using a window that closed the moment his Social Security deposit hit his account and his ordinary income rose. The lesson from Ray's story isn't that he eventually got it right. The lesson is that he had 2 years of runway because an advisor caught the window before it closed. If you're 45 or 50 right now, you have 15 or 20 years of runway. The window is wide open. The decisions you make with that runway will determine whether you get 2 years to repair at the end or decades to build it correctly from the beginning. One more thing I want to name before we get to the practical framework, because it's the psychological piece that actually determines whether any of this gets acted on. The reason most people don't restructure their contribution strategy mid-career isn't that they don't understand the math. It's that the cost of changing is visible today, and the benefit is invisible until later. Contributing to a Roth 401k instead of a traditional one means your taxable income this year is slightly higher. You lose the deduction. Your take-home pay might go down a small amount depending on your withholding. You feel that difference immediately. The benefit, the MAGI invisibility in retirement, the 0% capital gains access, the RMD flexibility that lands in your life somewhere around the year 2040. And human beings are not wired to feel a benefit that arrives in 2040 as strongly as they feel a cost that arrives this paycheck. This is not a character flaw. This is just how our decision-making architecture works. The financial system exploits this by making the pre-tax contribution the default because it feels better now. The immediate gratification of a lower tax bill today beats the abstract future benefit of flexibility at 73 every time, unless you understand the structure clearly enough to override it. That's the only reason I made this video. Not to tell you to save more, but to make the future benefit concrete enough that it competes with the present cost. There's a version of retirement that feels like a series of forced choices. How much do I have to pull from the 401k this year? Will this push me into the next bracket? Will this trigger higher Medicare premiums? Is this the year I go over the Irma cliff? The math works, technically, but there's no flexibility in it. Every dollar coming out is a dollar the government already has a claim on, and the terms of that claim aren't fully yours to negotiate. And there's a version of retirement that feels like a different kind of decision. Taxes are running a little high this year. So the draw comes from the Roth account. Tax-free, no MAGI impact. Next year, if the tax environment shifts, the plan shifts with it. The brokerage account is there if needed, sitting on long-term gains that qualify for 0%. Something unexpected happens. A medical bill, a home repair, a family need, and the response is a strategic withdrawal from whichever bucket makes the most sense, given the current tax picture, not a forced withdrawal from the only account that exists. Same net worth on paper. Completely different experience of living inside it. The difference is not how much was saved. It's how many choices were built. Here is the 3-road blueprint. Not a complicated system, not a product. 3 accounts, 3 tax treatments, 1 goal, which is optionality. Road 1, pre-tax. Traditional 401k, traditional IRA. Contribute up to the employer match because the match is an immediate 100% return, and nothing in personal finance competes with that math. Beyond the match, be careful about overloading this road. Every additional dollar you add is a future dollar of ordinary income you'll have no flexibility around. The booth is always staffed on this road. That's a deliberate choice you're making every time you put another dollar here. Road 2, tax-free, Roth, 401k, Roth IRA. In 2026, the Roth IRA contribution limit is $7,000 per year, $8,000 if you're 50 or older. Income limits for direct contributions phase out for single filers around $157,000 and for married filers around $236,000. If you're above those limits, check whether your employer offers a Roth 401k option, because the contribution limit there is $23,500 plus a $7,500 catch-up contribution if you're 50 or older. That's $31,000 into tax-free territory annually if you're eligible. And over 50, the tax you pay on these contributions today buys you magi invisibility in retirement. That's the price of the second road. Road 3, taxable brokerage. A standard investment account with a major custodian, Fidelity, Schwab, Vanguard, your choice. No contribution limits, no RMD requirements, no mandatory withdrawal schedule, no age restrictions on access. You fund it with after-tax dollars, invest in broad, low-cost index funds, hold them for more than a year, and the gains qualify for long-term capital gains rates when you sell. 0% if your income stays below the threshold, 15% above that. The flexibility here is unmatched by either of the other roads. The government doesn't set a withdrawal floor for this account. You access it when it's strategically useful, not because a formula tells you to. This is the road that allows Jane to take her European trip without a tax bill. It's also the road the financial system has the least incentive to tell you to build, because it's not a product, it's an account. You fill it with index funds and leave it alone. Boring, effective. The rough target is building enough in each of the 3 buckets that you have a meaningful choice each year about where your spending comes from. Not a precise 1/3, 1/3, 1/3 ratio. Just enough on each road that no single road is forced. If you're currently at 90% pre-tax and 0 brokerage, moving to 80% pre-tax changes the picture. Moving to 70% changes it more. Each dollar redirected toward roads 2 and 3 buys future optionality. That's the trade you're making. A slightly higher tax bill today in exchange for the ability to manage your own tax exposure in retirement instead of having it managed for you by the code. I genuinely don't know what tax rates look like in 2035 or 2040. Congress can change these rules. The 0% capital gains threshold could be restructured. Roth benefits could theoretically be modified. Anyone giving you certainty about future tax policy is guessing, including every financial commentator you follow, including me. What I can tell you with confidence is that the people who will be least affected by whatever changes come are the ones who built optionality before the rules shifted, not the largest balances, the most flexible structures. You cannot vote on tax policy from your kitchen table, but you can decide tonight which account receives your next contribution. 3 practical moves, not generic, specific to this. First, tonight, open your retirement account app. Find the summary that shows your current balance by account type. Calculate the percentage sitting in pre-tax traditional accounts versus everything else. If you don't have a taxable brokerage account at all, that tells you your current road count. The goal isn't to feel bad about the number, it's to know it. Second, if your employer offers a Roth 401k option, which most large employers do in 2026, log into your benefits portal and check whether you're currently using it. If you're exclusively in the traditional option, consider splitting your contribution. 50% traditional, 50% Roth as a starting point. You keep the employer match. You start building the second road. The impact of that split sustained over 10 years with a reasonable balance and a normal market return is substantial. Third, if you are within 15 years of retirement and your balance is heavily concentrated in pre-tax accounts, put a calendar reminder in your phone for the first year you expect to have lower income. A career transition, a planned leave, the early years of retirement. Label it Roth conversion window. When that lower income year arrives, model what you can convert and at what rate. That window may be worth more than any single investment decision you make between now and retirement. The system wasn't designed to make the second and third roads obvious. It was designed to make the first road the path of least resistance, because that's what's easy to administer at HR onboarding and easy to explain in a 30-minute benefit session. The complexity of the other roads works in the system's favor, not yours. Lazy investing built more fortune than crypto memes. Not because lazy investors got lucky, because they spent time building the right structure instead of chasing the fastest looking lane on the map. Bob's $290 tax bill isn't exciting. He's not going to tell you about it at a dinner party. He's going to be outside watering his roses before you found your keys. The story that ends there started 20 years earlier with a boring decision about which account received a paycheck contribution. Not a dramatic move, not a complex strategy. A routing decision made once and maintained. That's the whole thing. And the time to make it is while you still have income, contribution, eligibility, and enough runway for the roads to build into something real. After that, you're working with whatever roads you already